Welcome to the deep dive. Okay, so if you've ever felt that real gut punch of a loan rejection, maybe for your business, maybe personal stuff,
Yeah.
you're definitely not alone. And it feels like hitting a brick wall,
Yeah,
right?
yeah.
But what if it's actually, I don't know, a signpost?
Okay, let's unpack this.
That's a great way to put it, yeah. We see rejection less as an end and more like a clear roadmap, points you to specific things you can strengthen. So our mission here really is to explore why lenders often say no. What are the common reasons? Why do they care so much about these things? And most importantly, give you some clear, actionable ways to turn that no into a yes.
Yeah, that shift in thinking is huge. Okay, so let's jump in. First big hurdle, I guess, is the credit score, both personal and business. And it's kind of surprising, isn't it, that your personal credit still plays such a big role, even for business loans. Did you know your personal credit still rules? Oh, absolutely. It almost always does. Lenders, they start there. It's like the ultimate trust test for them. Common mistakes we see. High credit utilization is a big one. Like, say you're using 80% of your available credit limit. That looks risky. A really effective tip we found in the sources: try paying down those balances below 30%, but do it right before the statement closing date.
Ah, okay, not just by the due date.
Exactly, because it's the balance reported that hits your score. That can make a huge difference. And of course, late payments, those are major red flags. Then there's business credit, and it's kind of shocking, actually. Our sources show something like 45% of small business owners don't even know it exists.
Wow, 45%, that's a lot.
It is. So you really need to be checking your reports. Think Dun& Bradstreet, Experian Business. Establish trade lines, accounts with your suppliers that report your payment history, and just pay your vendors on time. Build that history.
Okay, so cleaning up credit, personal and business, that's step one. Huge.
Yeah.
But say you've got that sorted. What else trips people up? Here's where it gets really interesting. What about, like, legal stuff?
Yeah, legal red flags. Things like liens and judgments. Lenders see those as pretty serious issues. It suggests there could be problems collecting down the line, or other people might have claims on your assets. The fix is, well, straightforward, but crucial. You've got to resolve them, negotiate settlements, get proof. You need clear documents showing they're paid off, or at least that you have a solid repayment plan in place.
Right, makes sense. Dealing with liabilities head on. So, okay, legal stuff cleared, credit looks good. How do you then show them the money? Like, what does proving your financial health actually look like to a lender? What does this all mean for showing your money?
This is another common slip up. People often just provide their tax returns, but what lenders really prefer are clean, current profit and loss statements, your P&L. They want to see your actual cash flow month by month. Think about it. You might have, say, $200,000 in gross income on your tax return. But if you can't show a consistent monthly profit through a P&L, you might actually look less reliable. Less reliable than someone with maybe lower overall income, but who has steady, documented profits each month.
Ah, so it's about the consistency and the real-time picture, not just the big year-end number.
Exactly. So a tip here is maybe hire a bookkeeper or even just get good accounting software. Keep those financials truly lender ready all the time.
Okay, that's super practical. Lender-ready financials. Got it. Now, speaking of numbers they look at, I hear there's one particular ratio lenders really focus on.
There is. It's the debt service coverage ratio, DSCR for short. Basically, it measures how much cash your business generates compared to its debt payments. Simple division, net operating income, divided by your total annual debt obligation.
Okay, DSCR. What's the magic number there?
Well, generally, lenders want to see 1.25x or higher. So what that means is, for every dollar you owe in annual debt payments, your business should be bringing in at least $1.25 in net operating income. For example, if your yearly debt payments total $100,000, you'd ideally want net operating income of at least $125,000.
Makes sense. $1.25 for every $1 out in debt. And if your number isn't there?
You've got options. You can work on increasing income, obviously, or reduce your existing debt load. Sometimes even extending the loan terms can lower the annual payments, which helps the ratio.
Right. Okay, so we've got credit, legal, financials, DSCR. Are there other, maybe less obvious things they consider?
Right.
Soft factors.
Definitely. Industry risk is one. Lenders are often more cautious with certain sectors like restaurants, construction, maybe newer startups. They're seen as inherently riskier. You can help offset that with a really strong business plan, maybe offering collateral, highlighting your own management experience in that field. And then, yeah, the soft factors like your actual relationship with the bank or lender.
The relationship matters.
It really can. If your banker knows you, sees your business accounts, have steady activity, understands your plans, they're more likely to, go to bat for you. It's always a good idea to build that connection before you urgently need the loan.
That's a great point. So putting it all together, the big picture here seems to be about shifting perspective, right? Turning that no into more of a not yet.
Exactly that. Treat the denial as feedback, valuable information, not as a personal failure. The practical steps: first, ask the lender why. Get the specific reasons. Then go fix those things. Maybe it's credit cleanup. Maybe it's getting those P&Ls in order. Maybe it's paying down some other debt to help that DSCR. Then once you've strengthened those areas, you can reapply, maybe with better documentation or sometimes even for a different type of loan, like a line of credit instead of a big term loan.
It really reframes the whole experience. It's less about rejection, more about diagnosis and improvement.
It connects to a bigger picture, really. Loan rejections are often much more about your current readiness, how well you've prepared and documented everything, rather than your fundamental worthiness as a borrower or a business.
Readiness, not worthiness. I like that. So, as we wrap up this deep dive, maybe the final thought for you listening is, what stands out to you about transforming your financial readiness from this deep dive? What's one thing you could focus on?